Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, a federal budget that's big on spending, but not so big on balance, and redefining poverty. A new deprivation measure provides a better picture. Plus, Canada wants to stay in the green transition game, but are we going about it the right way? That's all ahead. First, for the week that was in business, it is time for the briefs. The federal budget increased the size of government spending by more than $50 billion, while a path to a balanced budget is no longer in sight. There was about $20 billion in spending to spur green investments and a dental plan that will cost $13 billion, plus an extension of the GST rebate aimed at helping low-income Canadians cope with inflation. Critics said the budget lacked a solid plan to help the economy.
Canada needs a growth agenda, and one just gets a sense that for various reasons, it's just not part of this government's DNA.
Extending that GST rebate put in place last fall will cost $2.5 billion. Under the program, a family of four would receive $467, while a single person would see $234 refunded. 11 million Canadians are expected to qualify. And the federal budget did not spare Canada's big financial institutions. On top of a new top-up tax on income above $1 billion, banks and insurers will now pay tax on the dividends they receive from owning shares of other publicly traded Canadian companies. It's expected to raise more than $3 billion over 5 years, but the policy could lead the institutions to selling those stakes instead. Canada's economy grew by more than expected in January, a gain of 0.5% after a contraction in December, with the stronger than expected showing making the Bank of Canada's inflation cooling agenda even tougher. A long-awaited all-clear from the federal industry minister paves the way for Rogers and Shaw to merge their telecom businesses, though with conditions attached on jobs and on spending to build out 5G networks. It also clears the way for Quebecor's Videotron to acquire Freedom Mobile, and that wireless player will have to offer 5G service everywhere within 2 years to compete with the big three. The Canada Infrastructure Bank plans to invest $277 million in a Quebec-based biofuel company. The facility aims to produce biofuels out of landfill waste and has a total price tag of $1.2 billion. It's a joint venture between oil and gas giants Shell and Suncor, along with Swiss natural gas firm Proman. Sales at activewear firm Lululemon were 30% higher over the 3 months ending in January, a sign of strength from consumers. And Lululemon said it sees sales gaining 15% this year, although it still has high levels of unsold inventory, a problem that is plaguing many retailers. That wasn't an issue for Dollarama. It said both sales and profit soared in the most recent quarter as consumers continued to hunt for bargains. And those are your business briefs. The centerpiece to this year's federal budget are tax incentives to spur the green transition. Here's a look at them by the numbers. First, the big number, $20.9 billion over 5 years, earmarked for tax credits to prompt green and clean tech investments. On the list, a 30% tax credit for clean tech manufacturing aimed at recycling and processing critical minerals, costing $4.5 billion over 5 years. There's a 15% clean electricity tax credit that could even go to Crown corporations, aimed at expanding a clean grid to manage future electricity loads. Cost $6.3 billion over 5 years. And hydrogen still gets a shout out, a 15 to 40% tax credit that could cost $5.6 billion over 5 years. And a previously announced 30% clean tech tax credit is being expanded, so its 5-year cost is now $6.7 billion. And then, of course, there's carbon capture and storage, an oil and gas sector favorite, which expanded eligibility, pushing the cost of those credits to $4.1 billion. Well, with stronger than expected economic growth and more spending from the federal government, does the federal budget risk putting the Bank of Canada in a corner on the inflation fight? Roberta Asselin is Senior VP of Policy at the Business Council of Canada. Roberta, thanks for being with us.
Great to be with you.
So I guess the only people who might be disappointed by the strong showing of our economy in January would be the folks at the Bank of Canada. Does it change the picture at all, do you think, in terms of the traction we're seeing? There's still some growth out there. We know the labor market is still strong, and the hope that things will slow enough to cool inflation.
I think it shows the lag in the bank's action over the last year. But, you know, you don't want this data to be there in 1 month and 2 months from there, because I think then it will change the bank's position and they might have to pivot and signal that, there's more hikes coming.
So we look for a slowdown, I guess, if you're the Bank of Canada, that everything's working. Meanwhile, of course, there was concern always if governments spend a lot, that is inflationary. Did you see anything in the budget that gives you concern on that front? It's a big spending budget. Let's be clear about that. It's a big size. But is the spending inflationary?
I don't see it that way necessarily, but what I see is spending plan that is still very expansionary overall. Deficits over the outlook horizon over 5 years. To my calculation, this is a government that has committed in new spending about $345 billion since budget 2021, only 2 budgets ago. So clearly, that money is coming into the economy, and it will have an effect. And I think I look at the debt-GDP ratio. It's obvious that they're not even following or wanting to meet their own fiscal anchor, which was declining debt to GDP ratio. Next year it will go up. And so I see this as worrisome trend for the federal government to continue to spend at that level.
Yeah, the anchor that they told us should be the one to watch is now kind of working against them. Some of the big ticket items here, it's almost like we're kind of going back to the pre-pandemic vision, which was green transition and spending big to sort of position Canada in a new economy. Tax credits seem to be the favorite way to dole out this money rather than direct subsidy, although there's still some of that. We can get to that in a minute. But do you like tax credits as a way of trying to incentivize these new business opportunities?
I think it's a partial response, but when you look at how the Americans do industrial strategy, it's much more comprehensive. They do a science-based play. They have, NASA for space. They have DARPA for defense. They have the science strength behind it that we don't. This is very, relying on market when you talk about tax credits. And then the regulatory side, in Canada, it takes a lot of time to issue permitting, to get stuff done, the big stuff especially. So we have to fix that part. Otherwise, I'm worried the tax credits on their own won't be sufficient.
Not a ton of time, but one of the direct spending that we might see, we don't know the number yet, but there's a strong suspicion that money will go directly to Volkswagen to build that big battery EV plant here in Canada. Is that the correct thing to be doing, to actually directly incentivize companies?
It's not my favorite way of doing it, to be honest, Amanda. I understand why they did it. They want to try to build an ecosystem in EVs, especially around batteries. I like that it's an advanced industries. I like it that it is R&D intensive, that it will employ high-skilled workers and will boost our productivity as a result. But given we don't know the amount that the government has given, it's hard to be definitive about whether this was a good deal or not. But overall, I support Minister Champagne's willingness and action on trying to create an ecosystem in Canada around EVs. All
right, Robert, we've got to leave it there, but it's great to have you with us. Roberta Rivera is Senior VP of Policy at the Business Council of Canada. Coming up, how to win in a race for investment in the new economy. Stay with us.